With a simple sales budget created, let's now add the return value and rate we expect to see for the period we're budgeting for. Starting point would be to gather historical information on what the return value and return rate has been in the past. Still using last year's figures, we had a return value of $149 for the period, which translates to a rate of 15%. The rate has been calculated by dividing the return value into the sales value. I should mention at this point that the sales figure of $995 that we had for last year's sales does not reflect the return value. And as all we really want from last year's budget is what the return rate was, which in this case was 15% for the period, we just divide the return value into the sales value. Now to calculate this year's budget, taking the return value and rate into consideration. For the simple budget we have created, we will show a reduction in the return rate we expect to see over the period. In other words, we want to have less returns this year in comparison to last year. So, for this year, we're going to have a return rate of 10.5% for the period, and we'll now perform a step-by-step calculation on what the revised profit line is going to be. Step 1. Calculate the return value by multiplying the return rate by the total sales figure, including return. This gives us our return value, which comes to $109.98 for the period. Step 2. Calculate sales excluding returns by subtracting sales including returns, which is a value of $1,044.75, from the return value we've just calculated of $109.98. This gives us a sales value excluding returns of $934.77. Step 3 is to calculate the sales excluding returns less the sales tax. We're still using a sales tax rate of 10%, and this calculation gives us a sales figure excluding returns and tax of $849.79 for the period. I am now going to refer to this figure as our sales figure, as it's a bit of a mouthful, not to mention confusing, to constantly say sales excluding returns less sales tax each time I want to refer to this figure. So step 4, we're going to keep the margin rate unchanged at 61.9% for this year's budget. Step 5 involves calculating the cost of goods sold. The formula again for this is sales minus, open brackets, sales multiplied by margin rate, close brackets, and gives us a figure of $324. Step 6 is the final step, and this is to calculate the margin value, which we do by subtracting the cost of goods sold from sales. And this value comes to $525.79. The simple sales budget is no longer as simple once we take returns into account. We do, however, get a better indication of how much profit we plan to make over the period we are budgeting for. Calculating returns in this way as part of your budgeting process is optional, and also depends on what your return policy is. If you do not accept returns, then there is no need to include this. If you do accept returns and you do not have any historical figures to show a return rate, you can calculate your return rate by estimating what the return rate would be. For instance, you could say for every 100 units you sell, you expect 3 to be returned. Convert this into a percentage and you get a 3% return rate. You can use this as your return rate while budgeting. A tip when working on returns: it is best to calculate the return rate first and convert that to a value using the formula return value equals the sales multiplied by return rate.